Hello, you traders. I'm King from Unicapital Securities. I'm a research analyst for almost 2.5 years now, and I'm currently covering the property, telco, and gaming sectors. Let's make this quick. I don't want to take much of your time. Let's now move on to our agenda for this webinar. First, I will update you on the index performance, followed by a review of third quarter company earnings and our outlook for the fourth quarter this year. Next, we will be talking about the stocks we cover that currently have the highest upsides. Lastly, we will share some strategies to help you with your investing in this kind of market condition. For the PSEI year-to-date performance, the PSEI zoomed past 7,000 level for the first time since February. The index is now only down 10% versus 20 to 22% in late August. This recent rally was on the back of number 1, new daily COVID-19 cases in the Philippines dropped. From a peak of 3,300 daily cases in August, it has gone down to 1,400 as of November, according to the DOH. Number 2, looser lockdown. The government continued to reopen the economy by imposing less stricter quarantine measures starting from late August. This positively affected corporate profits based on the quarter-on-quarter numbers, thus contributing to the increase in share prices as investors welcome this development. Number 3, positive vaccine development. Moderna announced in November that preliminary analysis of its trial indicated that the vaccine was almost 95% effective. Other companies like the New York-based Pfizer and German company BioNTech also presented preliminary data indicating that the coronavirus vaccine was over 90% effective. These positive developments was mostly the reason why the market shoot up in November. Despite the rally, some market participants remained cautious. For one, investors fear that a virus resurgence may occur, similar to what happened to countries in Europe, which resulted in the reimposition of lockdown measures to prevent and mitigate further spread of the virus. Another fear of the market is that the slower than expected economic recovery may happen and could hinder corporate earnings in the future. The bottom line here is that the market is now biased on the upside, in our view, on the back of optimism that a vaccine will be developed next year. For the PSE sub-indices year-to-date performance, again, PSEI is now only down 10% year-to-date due to the recent rally that brought the index to 7,000 level. Same as in our last webinar, the financials index was still the worst performer, being down by 21% year-to-date. This is due to the expectation of higher loan defaults amid the challenging environment. Property was the second worst due to strict lockdown, which resulted in construction halt, limited mall operations, and hotel operations, which caused bad earnings for property companies. For the index members' performance, resilient sectors were still telco and consumer, primarily those from retail, grocery, or those who has heavier exposure to essential goods. The worst sectors were banks and property because again of loan defaults, construction halt, limited mall and hotel operations. For the earnings review, primarily on banks, earnings were mostly down due to the recognition of higher loan loss reserves, but worth noting were the sustained growth momentum in net interest income and lower cost of funding, as banks have repriced deposits in line with the BSP's cumulative rate cut of 200 bips. The low interest environment also made it conducive for banks to book securities gains, which offered cushion for the elevated loan loss provisions. Our outlook is Bayanihan 2 might boost bottom line since banks may not book higher defaults in the fourth quarter, thus the less need for significant provisioning. We might see a more encouraging credit growth as the economy reopened in the BSP's surprise rate cut this November. But banks could remain selective in handing out loans. For consumer, restaurants suffered the most, namely JFC, Pizza, and Max's, as stores were forced to close during the strict lockdown during mid-August. Groceries or manufacturers of essentials recorded higher earnings, and on a year-on-year basis, Earnings still declined or flat as stores either operate on a limited capacity or closed as part of their rationalization. On a quarter-on-quarter basis, results mostly improved on longer operating hours and capacity. Supply chain constraints also have been addressed as the economy reopened further. Our outlook for consumer: restaurant operators might continue with their rationalization program and also implement boosting new frontiers, including cloud kitchens, e-commerce platform, and alternative sales channels. Again, further lockdown would mean more lost revenues for these consumer companies, and definitely this would result in bad earnings. For property, on a year-on-year basis, significant declines were registered, with the sector being one of the hardest hit due to lockdown measures and travel ban. On a quarter-on-quarter basis, results were mixed, with the volatility in residential revenues being the major factor, as construction completion varied for each players. For the residential segment of these property companies, revenues rebound with better construction activity as the third quarter had looser restrictions compared to the second quarter. For malls, revenues also rebound significantly as operating merchants increased and foot traffic improved in the third quarter by about 30 to 35% of pre-COVID levels versus the 20 to 25% during the second quarter. Going to the office, this segment was strong, but it was not enough to offset the other segments. For hotels, as expected, revenues were still soft as travel restrictions remain in place. Our outlook for the sector: rebound is expected to spill over to fourth quarter as key players ramp up its residential project construction as mobility improved. Mall foot traffic is expected to improve due to the reopening of the economy, and office segment is expected to sustain its operations moving forward. For the telco, on a year-on-year basis, Globe posted a decline while Tel's earnings grew on the back of strong mobile and broadband segments, outperforming Globe based on survey results. On a quarterly basis, Tel also outperformed Globe due to its continuous growth in mobile and broadband segments. The X factor for Tel's outperformance was its stronger foundation in the broadband segment, as well as the more reliable and faster mobile broadband services of Tel. Survey results from Ookla, OpenSignal, and Umlaut showed that PLDT or Tel was the superior telco operator based on reliability, availability, and speed of services. We think that Tel would most likely finish stronger, with revenue momentum expected to carry over to the fourth quarter. For power, on a year-on-year basis, earnings were mostly down mainly due to the lower power demand caused by temporary closure of businesses caused by the lockdown. On a quarterly basis, recovery was seen with the availability of more power facilities and the easing of lockdown measures, resulting in higher electricity sales. Our outlook for the power sector is that further recovery is expected as looser lockdown measures were imposed. Commercial and industrial establishments is expected to boost power demand going forward. For the cement sector, on a year-on-year basis, earnings recovery was seen as cement volumes picked up with the resumption of major infrastructure projects in the country. On a quarter-on-quarter basis, major rebound was seen coming from the strictest lockdown in the second quarter to a looser third quarter, resulting in significant increase in cement sales during the quarter. Our outlook for cement is that expectation is positive as more sectors of the economy are reopened and the government are doing a catch-up on its infrastructure projects. For the gaming sector, on a year-on-year basis, earnings turned to losses across the board following PAGCOR's order to shut down casino operations since the lockdown period started in March. Quarter-on-quarter basis, losses were narrowed as casinos were allowed to operate on a dry run basis while hotel and F&B facilities were also allowed to operate on a limited capacity. Our outlook for the gaming sector is the fourth quarter will do no better than the third quarter unless PAGCOR will allow casinos to reopen to the public and if travel bans or restrictions are lifted, which we think is unlikely since cases continue to rise on a daily basis. For the infrastructure sector, on a year-on-year basis, earnings turned to losses as construction activities were halted with the imposition of lockdown measures. On a quarterly basis, losses mostly narrowed as the economy reopened and construction activities start to pick up. Our outlook is fourth quarter is expected to post better earnings with key players ramping up construction on the back of improved mobility due to looser restrictions. Despite the positive outlook on construction, M-Wide could still post ugly earnings with its airport segment expected to record significantly lower passenger volumes as travel restrictions remain. For oil, on a year-on-year basis, mixed results were seen but sales volume generally improved as the economy continued to reopen during the quarter. On a quarterly basis, significant comeback happened coming from the strictest lockdown in the second quarter to a looser third quarter, resulting in sales volume and earnings rebounding during the third quarter. Our outlook is the gradual reopening of the economy is a positive for the sector, as well as loosening of restrictions for travel and tourism, which could result in further rebound in oil demand. Some updates on the oil sector. Pcor and Shell PH shut down or will shut down their respective refineries, mainly because of poor refining margins and tax issues. This will change the business models of Pcor and Shell PH, which warrants further review on the company. We now go to our covered companies with the top upsides. First off, P-Gold, AP, and Metrobank have closed or higher than 30% upside after our most recent updates with these companies. A little over 10% upside are Fly and SecB. Most of the high upside stocks right now are on the banking and property sectors because they are laggards compared to the PSEI. Again, the financials index is 21% down year to date, while property is 16% down, compared to the PSEI's year-to-date decline of only 10%. These sectors could drive the market moving forward, given their attractive valuation and upside potential. The strategy for these stocks is accumulation for the long term, and we suggest you buy in tranches to limit your downside risk. We also listed some notable pullback stocks or stocks that we feel that will continue to record good earnings relative to other companies, especially Globe and Tel. We added Meg in the list because of its relatively heavier exposure in the office market, which right now is the one segment that is driving property companies' earnings, and Meg also has one of the strongest balance sheets in the sector. The strategy for these pullback stocks is to patiently wait for a pullback or prices to decline until a double-digit potential upside is present. Again, for the strategy, accumulate the high upside stocks for the long term as valuation and potential upsides are tracked. Resilient stocks have narrower upsides, but a pullback might be an opportunity to re-enter. Tailor fit the stocks you buy depending on your risk appetite. There are a lot of stocks offering good upsides, but not every stock suits an investor's style. Do not buy into speculatives if you have a low risk tolerance. Lastly, always exercise proper risk management to avoid losing significant amount of your capital. For the summary of our discussion, most of the companies recorded significant year-on-year earnings drop or recorded losses in the third quarter, mainly due to the impact of lockdown measures to fight against the spread of COVID-19. Quarter-on-quarter, performance looks encouraging with the further reopening of the economy through looser lockdown measures, which should carry over to the fourth quarter of 2020. The essential sectors rally in the second quarter almost exhausted their upside potential. Pick higher upside stocks but accumulate or buy in tranches to limit downside risk. We believe that the market is exerting an upside bias due to the positive developments of a coronavirus vaccine as well as expectations of better corporate earnings for 2021. Just to inform you, we will have our year-end webinar on December 28th, so mark your calendars to join the event. You can also check our social media accounts for news and updates regarding our events and webinars. That's all for me. Thank you, you traders.